In today's video, we are going to explore why it feels like no one is retiring before 65 anymore. I'm a certified financial planner and the owner of an independent financial planning firm. And every year, we help retirees time their retirement perfectly, and in many cases, retire earlier than they might think is possible. It seems like every other week, another article comes out exclaiming that the rising cost of living is pushing retirees further and further away from their retirement goals. And as a result, for many people, retiring at 65 feels like a distant fantasy. But the question is, while it feels like an age 65 retirement may be impossible, is that actually the case? Now, today's video is going to walk through why it feels like no one is retiring before 65 anymore. But retirement can come sooner than you think. Today, we're going to comb through some data from the Bureau of Labor Statistics to find out, is it actually getting so much more expensive to live that it would be prohibitive or even irresponsible to retire at ages that previous generations would have considered standard? I'm going to take us through 6 concepts in this video. The first, what has the actual change in cost of living been? The second, have incomes kept up with the change in cost of living? Third, are the most common expenses, things like housing, food, transportation, are they actually eating up a larger and larger proportion of Americans' household budgets? The fourth concept will be, are people affected differently based on their household income by changes in the cost of living? Fifth, what is the actual relationship between market returns and the change in cost of living? And then finally, we're going to review the maximum tolerable portfolio withdrawal rates over a 30-year time period to stress test the findings of this project. Now, I highly recommend you stick with me through this video. The findings were not at all what we are led to believe, and I think you'll find the data both fascinating and probably refreshing. Now, in a second, I'm going to show the average annual increase in cost of living from 1992 to 2023. But before I do, I need to explain the difference between inflation and cost of living. So cost of living refers to the actual monitored increase in spending done by actual US households. It references what you actually pay for the goods that you actually purchase. And this data is tracked and reported on each year by the Bureau of Labor Statistics, which is where all of the data that I'm using in this video has been pulled from. Inflation, however, is an economic measure of the increase in a cost of randomly determined, not exactly random, but government determined basket of goods and services without regard for if those goods are actually purchased or who purchases that exact basket of goods. And so for this reason, cost of living as pulled from the BLS data is actually a much better measure of how much more expensive it has gotten to live. From 1992 through 2023, the average annual increase in the cost of living has been 3.04%. And you can see that here on the screen. Now, the question is that bad? Is that good? It's really not actually a sufficient data point to use alone. So what we're going to do is look at the second summary table I'm going to pull up on the screen here. And we're going to compare data with the BLS Consumer Expenditure Survey. We're going to compare the data they provide on changes in annual income from 1992 to 2022 against the change in the annual expenditures or cost of living over that same time period. And you can see here on the screen that the annual income has grown by 177% over that time period, while annual expenditures have grown by 144%. Now in green here, you can see that income growth has actually outpaced expenditure growth by 33% from 1992 to 2023, which is a fairly positive sign. But just because income growth outpaced spending growth doesn't mean that particular important or maybe even non-negotiable categories of spending, like housing or food and groceries, were not growing out of control over that time and crowding out things like entertainment or travel. And so because I'm a nerd and the details actually really matter, I put together this summary table here, which shows how much as a percentage of the total household budget goes towards most common areas of spending, specifically housing, food, transportation, healthcare, apparel, and services. I had my intuitions about what I'd see in this particular summary table before I pulled the data. Let me tell you that I expected to see a much larger increase in housing, say something like 10%, and that housing would have grown over time to take up a larger and larger share of household budgets. And I thought the same would be true for food. However, you can see from this column here labeled difference that in fact, housing ticked up only quite marginally, while food actually ticked down by roughly the same amount over that same time period. And from this summary table, we can see that the share of each household's budget that went to housing only increased by 1.5% over this period of 30 years. And for food, it actually decreased by 1.5%. Transportation also decreased by 0.75%. Healthcare increased by 2.5% for the largest proportional increase. And then apparel and services actually saw a decrease of 3%. Now, on net, what is really happening here is basically a small reshuffling of where household money actually goes, but nothing that appears to be overly dramatic or catastrophic. And as I scraped all this data and reviewed the summary tables preparing for recording this video, I thought to myself, well, so far none of this really looks quite as bad as the news and the media and other parties make the situation out to be. But there was still this lingering question in my mind. Is any of this data distorted by the fact that expenses might go up quicker for households that say make less money or maybe make more money? Well, the BLS, Bureau of Labor Statistics survey provides some data on that as well. So let's take a look at that together really briefly. Now, this chart on the screen here shows the percent change in annual expenditures broken down by what's called income quintile, which is basically how much money households actually make. There are 5 income quintiles. Each quintile represents 20% of the population. So the bottom earning quintile is for households that make less than $30,000 in annual income. The second quintile for households that have $30,000 to $58,000 of annual income. The third quintile is $58,000 to $94,000. The fourth is $98,000 to $153,000. And the fifth is anything above $153,000. Now, what we see from this chart here with the blue lines and the gray lines is that changes to income and cost of living actually do vary very widely across the income spectrum. When we look into data over a longer period of time, it does appear that over the past 30 years or so, the share of income in the lower 2 income quintiles, so everybody who makes less than $58,000 a year as a household, the share of their income that goes towards housing and food has increased at a faster rate than the other 3 income quintiles. But actually, even that effect is rather small. The lower 2 income quintiles only saw their share of funds allocated to housing and food increase by about 2% more than the rest of the income quintiles. Now, this essentially communicated to me that while yes, changes in cost of living and income do affect households differently, it is not actually in such a substantial manner to be a primary concern. Now, up to this point, everything has been pretty interesting so far, but we need some additional data to actually help understand how changes in cost of living affect retirees, people who will no longer be working and need to rely on non-wage income to survive in retirement. To do that, we're going to compare portfolio returns over that time period from 1992 to 2023 against the change in cost of living. And this summary table that I'm bringing up now shows just that. So using backtesting data using a standard 60% stock, 40% retirement portfolio, all in mutual funds, we see that the average rate of return over that time period was 9.45% compared to the average change in cost of living, which was 3.04%. So on average, the 60-40 portfolio grew about 6% above the growth in the cost of living. But how did that differ over narrower time periods? So one of the things I talk about a lot on my channel is that averages can hide important data that lie beneath the surface. And so one of the questions is, has the growth rate in cost of living increased over time? Is that growth rate in cost of living accelerating? What about what's actually happening with the growth rate of that 60-40 portfolio? So what we did is we also tested averages over 10-year periods. And what you can see here is that from 1992 to 2001, cost of living went up an average of 2.94%, while that 60-40 portfolio grew about 11.28% per year. And then from 2002 to 2011, the growth in cost of living actually decelerated. It stopped growing quite as quickly, but it still grew at an average pace of 2.35% per year, while the 60-40 portfolio also decelerated much more substantially, growing by only 5.28% over that period. And then finally, from 2012 to 2022, cost of living growth accelerated quite quickly up to 3.7% per year on average, while that 60-40 portfolio growth also accelerated back up to above 11% at 11.5%. Now, it's not perfectly clear how much that relationship actually matters, the change in pace of growth of cost of living against the change in pace of growth of an investment portfolio, but I do think it is safe to say that the relationship is critically important. Obviously, the higher the spread between those growth rates, the more cushion or safety a retiree has. So to get an understanding of how retirees would actually have been affected a bit better, I backtested the same 60-40 portfolio over that same time period, 1992 to 2023, but this time I added in distributions, withdrawals every year for a retiree who would be living off of that portfolio. I tested two types of distributions, one called fixed withdrawals and one called inflation-adjusted withdrawals. Now, fixed withdrawals means that the retiree would, at the start of retirement, choose a percentage of the portfolio to draw each year, say 5%. Then that retiree would start each year and calculate 5% of the start of year portfolio value and withdraw that percent. And because the percentage is fixed, it's not adjusted later years of retirement, and there would be no inflation adjustment in that scenario. So for example, if you had a $1 million portfolio in year one, you would withdraw 5%, which is $50,000. And if the portfolio was worth $1,100,000 in year two, you would withdraw 5% of that $1,100,000, which is $55,000. And then if the portfolio went down in year three to $900,000, you would withdraw again 5%, which is now $45,000. So it's a very dynamic approach. It's actually a softer, more conservative approach to withdrawals on a retirement portfolio. Now, inflation-adjusted withdrawal distributions would mean that the retiree would choose at the start of retirement a percentage of the portfolio to draw each year, let's say 5% again, and then they would take 5% out in the initial year and then inflation adjust that amount for each year going forward, regardless of the portfolio's value in ensuing years. So if you have a $1 million portfolio in the first year, you would withdraw $50,000, and then each year you would adjust that $50,000 based on that year's inflation, regardless of whether the portfolio went to $1.1 million or to $900,000 in value. And the inflation-adjusted withdrawal approach is actually the more aggressive of the two approaches, which you'll see evidence of in just a couple of moments here. Now, for both of these types of withdrawals methods, I tested a 5%, 6%, and 7% withdrawal rate to see how the retiree would have fared over that 30-year period from 1992 to 2022. Let's take a look at the results together. In the case of the 5% fixed withdrawal, if you had started your 30-year retirement with a $1 million portfolio, you would have ended your retirement period with almost 3 times your starting wealth, 298% of your starting wealth to be exact. Now, in the 6% fixed withdrawal scenario, start to take more out, you would have still ended your life with 2.15 times your starting wealth. And even when we get to a 7% fixed withdrawal rate, as you can see here, you would have ended your life with 1.5 times your starting wealth. Now, if we move to the more aggressive inflation-adjusted scenarios now, clearly what we're seeing here is that a fixed withdrawal scenario still leaves spending flexibility. It can tolerate more spending. When we move to the more aggressive inflation-adjusted scenarios, a 6% withdrawal rate would still have left you with 1.6 times your starting wealth, and you would have actually drawn or taken distributions of about $3 million out of that starting $1 million portfolio over that time and still been left with $1,600,000 at the end of your life. Now, only when you get to a 7% initial withdrawal rate do you actually run out of money while alive, and in the scenario tested over that exact time period, it would have been in the 29th year of your 30-year retirement. Now, we don't know how long anyone's going to live, but if you retire at 65 and the average life expectancy is somewhere between 82 and 87, there are reasonable odds that you would still never have run out of money in this scenario. And while people do live much longer, and we can't safely say no one would have run out of money, it still shows the fact that even at a 7% withdrawal in an inflation-adjusted scenario, the odds are that many people would not have run out of money over that time period. Now, on top of this, all of this was over a period of historically poor market returns. 7 out of the 30 years that we're discussing were actually negative, and during the great financial crisis from 2008 to 2009, you would actually have seen the total stock market draw down nearly 50%. Now, there are tons of interesting tidbits that can be found and beneath the surface of the summary tables here and in the underlying data, but I'm really only going to share 3 lessons I took away from everything I've shown today because of time. The first is that there is undoubtedly a limit to portfolio withdrawal rates. And the year in which you retire and your retirement period, the time period over which you live in retirement, those do really matter, but it appears that sustainable withdrawal rates are actually much higher than we are led to believe. Now, this is especially the case when you consider the fact that there are dynamic withdrawal strategies out there, like modern guardrails, that can give you really clear boundaries about what your portfolio can tolerate each year. Even more so, we don't really live in a vacuum. When markets do poorly or cost of living accelerates, we change our behaviors and our spending patterns. So when the great financial crisis happens or the dot-com bubble pops, we actually change how we spend in real time. The second takeaway from this content is that for retirees, even if cost of living is increasing, as long as there is a healthy margin between the growth rate of our incomes or assets versus the growth rate of the cost of living, we will be okay. If it is at all true that it is becoming more difficult to retire, it is not because of the increase in cost of living, but rather a result of poor discipline. People are spending more than they're making, they're saving less than they have in the past, and are less willing to delay gratification. And these are all discipline problems, not economics or markets problems. The third point in this video is that retirees actually have a bonus superpower that I haven't shown yet. I'll bring this up on the screen here. 80% of Americans over 60 own their own home. And the median home equity for those retirement age homeowners is actually $250,000, meaning many retirees may own their home outright or have substantial equity in their homes and will end up owning their homes outright shortly into retirement. And as a result, their cost of living will actually go down substantially at some point in retirement when their mortgage expenses drop off. Now, on top of that, their house kind of acts as a bucket of funds that is actually growing over time and could be tapped into as backup if needed. Now, at the end of the day, my final thoughts are the following. As people are told to be more hands-off about their retirement planning, to use things like asset allocations and target date funds and automated savings plans, they become less and less in touch with their retirement efforts and actually more anxious and more uncertain. And as a result, they become more susceptible to bad information. Headlines that tell us retirement is dangerous, that it's more expensive, to delay and delay and delay. And we never really challenge that narrative by asking ourselves, what is the purpose of that messaging? We're fed this fear-based narrative that we will not have enough. But that's not really the reality if you have actually been a diligent saver. With a good understanding of what I've shown today and an effective dynamic retirement plan, retirees who have diligently saved and invested can likely retire far earlier with far more stability and far more flexibility than they are led to believe. Remember, the parties that write the articles that fund the research like this one here from Northwestern Mutual entitled Americans Believe They Will Need 1.46 million to Retire Comfortably, they have a vested interest in you not using your wealth for the purpose that you intended. They continue to profit by using the fear they stir up to sell insurance, annuities, and keep people from drawing down their assets in retirement so that those assets grow and the annuitized fees grow with them. All right, I'll stop preaching for now. So I hope you found this video helpful and informative. If you'd like to learn more about how we at Peak Financial Planning help our clients confidently retire and understand their spending tolerances of their portfolio, you can visit our website at www.thepeakfp.com. And as always, thank you for your time and attention, and see you in the next video.